Happy weekend. Welcome to our session today. We've got a great group of guests joining us. We're going to be talking about advanced DeFi and how we're thinking about new liquidity models and capital efficiency in DeFi protocols. We've got a great lineup of partners joining us today. We've got uh, Dairy Protocol, Venus, and Alpaca Finance joining us. We hope you guys enjoy the discussion. We're going to be covering a number of topics, talking about some of the new trends in DeFi, particularly looking at some of the DeFi 2.0 protocols and the new liquidity models being introduced and experimented with. And we'll look forward to hearing some of the thoughts from our panel today. So let's bring them on and let's say hi. Hey,
Hello.
Zio, how's it
Hey
going?
guys.
It's good to have you. Yeah, so let's start maybe with a quick round of introductions. Zero X Alpha, would love to hear a little bit about you, how you got into the DeFi space, and would love to hear more about Dairy Protocol and what's new, what you guys are working on at the moment, and what we can look forward to.
Okay, cool. Thank you, Sammy. Hey, hello everyone. I'm Alex Alpha, the co-founder of Dairy Protocol. Dairy, as you probably already know, Dairy is the leading derivative protocol on Binance Smart Chain. Quoting this formula on the front page of our website, Dairy Protocol equals to perpetual futures plus everlasting options times decentralized, which says we provide a DeFi way to trade derivatives, including perpetual futures and everlasting options and more. And what's going on with us is in next week, we're going to roll out the Dairy V3, the third version of Dairy Protocol. And this is going to be in a partnership with Venus. So please stay tuned. And we're talking about that tonight.
Awesome, awesome. Hey, James, how's it going? Great to have you with us.
Yeah, good. Thank you. Thanks for having us. So I'm James. I'm head of business development at Alpaca Finance. We're the largest lending protocol allowing leverage yield farming on Binance Smart Chain. So essentially, we help lenders earn safe and stable yields, and we offer borrowers under-collateralized loans for leverage yield farming positions.
Very cool. I'm sure we can see in the chat we've got a lot of Alpaca fans joining us today.
Good.
Hey, Brad, how's it going?
Hey, Sammy. Hey, everybody. And thanks to Sammy for hosting this. I'm the product lead for Venus Protocol, which most of you have probably heard about. But if you haven't and you're new to the ecosystem, Venus is one of the largest lending protocols on BSC, one of the largest in crypto. And the mission of Venus is to create absolute alignment of incentives around lending that's universally available. So the core of Venus is built with Legos from Compound and the money market for the money market side, and also built with Maker for minting and supply of our native stablecoin Vi. And this unique combination has really made Venus a leader in our ecosystem because we can offer both a primary and secondary market for lending with these Legos. So happy to be here and talk more about advanced liquidity with you guys.
Awesome. Great to have you guys with us. So maybe just set the context a little bit, even for the audience, right? So like today, we're at the start of 2022. Like we're probably like 1.5 years in from when we started seeing really significant growth in DeFi, right? So that was really kicked off by Compound launching the Comp token. Obviously, some DeFi, OG DeFi protocols go back several years at this point, like Uniswap and several others. But we really saw this massive growth in especially TVL starting in summer 2020, and then a lot of new users coming into DeFi with the launch of BSC and now many other EVM chains, which provided this kind of low cost, low transaction fee infrastructures that could support a much wider audience of users participating meaningfully in DeFi. But I think what's also happened here is we've seen some of the limitations of um, token-based liquidity mining incentives, where you have this kind of constant selling pressure, and there's a number of other challenges, as well as mercenary capital in DeFi, where you have, of course, due to like super low transaction fees, very easy for users to add LP, remove LP, and basically chasing highest returns wherever they can. Also, more recently, now we've seen a lot of innovations around the models around liquidity incentives. Was really kicked off, I think, or the one which had the largest traction so far is probably Olympus DAO, but we've seen a number of other interesting experiments happening here with projects like Abracadabra with their MIM stablecoin and Frax and many others. So interested to hear from you, like how sustainable do you think these approaches are? What are the kind of benefits? What are some of the things that project teams, developers should be thinking about that they're not already when considering these types of liquidity models? Maybe James, we can start with you.
Yeah, sorry, my connection isn't great, so I only caught part of that. But yeah, I think that DeFi historically we've had this like weird focus when it comes to like TVL, right? Everything's TVL, and it's like I think the focus on TVL is kind of outdated its usefulness. And it's sort of what TVL does is it paints like a high level picture of how much capital DeFi smart contracts can basically hold, right? And it's only a partial metric because it fails to track how that capital is used. So, for example, if a DeFi project has like 200 million in TVL and we only consider that metric, we might consider it to be doing quite well, right? Upon further inspection, if we saw that it had 0 users and funds sitting just idly, we'd start questioning its health. And I think that so TVL only tells part of the story, and I think we need to look at capital efficiency to truly understand what's happening in a protocol. Like after all, if the goal here is to build like this new financial system that eats the world, we need to kind of prioritize the usage of capital, not just like, aggregation, right? So for anyone who's used one of the major DeFi lending protocols, I think you'll know that one sort of endemic issue within DeFi lending is the lack of capital efficiency at the moment. So if you put up $1 as collateral, you might only be able to borrow 50 cents, right? So if you then use that 50 cents to yield farm or whatever, like the historic usage case has been, won't you just be earning less than if you use that $1 from the start, right? This limit is kind of prohibitive for many lending use cases. And what we've tried to do anyway at Alpaca is obviously with leverage yield farming, something that we wanted to address kind of straight away, right? So unlike most traditional lending platforms, leverage yield farming, so what we do allows for under collateralized loans, which I think is kind of like one of the key things here, right? Like that's where we want to get to, is trying to find ways to not have to post 200% collateral all the time, right? So I think this higher capital efficiency means not only higher APYs for our users, like farmers, but also for lenders, right? As a result of this under collateralized model creating these higher utilization rates. So yeah, I mean, I think we've also continued recently. So I don't want to talk for too long, but we've continued work here with our auto farming stablecoin, so AUSD, whereby users have to choose between staking their asset. So sorry, people don't have to choose between staking their assets to earn yields or staking their assets as collateral to borrow against, right? So with AUSD, which is our stablecoin, users no longer have to make the trade-off. So again, we're always looking to improve capital efficiency where we can. I think different protocols have done it in different ways. I think it's kind of like a wait and see approach to see which approach is going to be the most successful going forward. But it's good seeing that DeFi protocols are actually trying to do this and they haven't just got stuck in kind of the original sort of just go and farm at sort of 200% over collateralization. So I'll let other people speak.
That's very cool. Thanks a lot. Definitely, we're going to talk a lot more about stable coins and AUSD as well. 0x Alpha, interested to hear this. James raised some really interesting points about how we're really measuring growth of DeFi. So TVL is one metric. I do agree with James, like not a very good metric to kind of get a more holistic view of overall growth. I think capital efficiency is definitely a really key part of it, but probably is not is now getting more and more attention. But I know that's an area you guys are thinking a lot about. So interested to hear more about how do you guys really think about that, and how are the ways that you guys are tackling that challenge?
Yeah. So the keyword capital efficiency. Actually, capital efficiency is one of my favorite topics, as always. Ever since the launch of V1 which is in February 2022, 1 year ago, improving capital efficiency has been a mission of their protocol. I think it's fair to say that the evolution of their protocol is the evolution of capital efficiency. And we are rolling out, just as I mentioned, we're rolling out Dare V3 next week. We're gonna bring the capital efficiency to a new level. Basically, we're gonna roll out a new mechanism called external custody, which we think this is going to be a new trend that defines the so-called DeFi 2.0. Specifically, the external custody refers to the practice of leveraging some other protocol to hold the liquidity involved in our trading business. In particular, we chose Venus to be the partnering protocol of our external custody. Meaning, what does that mean? It means the capital involved in Darius trading business is actually stored in Venus. So the keyword of this partnership is, I think, can be summarized as division of jobs or division of work. When it comes to dealing with the liquidity, basically there are two roles: those who use the liquidity and those who manage the liquidity. If you think about how liquidity is being dealt with, so there are these two roles: user and manager. So currently, I think most of the DApps are really users of liquidity, and their protocol is one of them. However, I think a lot of the apps are playing the two roles actually simultaneously. The liquidity, so there are two roles: liquidity users and liquidity managers. But for most of the time, the liquidity users right now are playing the role of liquidity managers for themselves. And most of the time, this might not achieve the best capital efficiency. And that is what we learned from Dare V2 when we were looking to this capital efficiency issue of Dare's trading business. But by that, I'm not saying Dare V2 is of a very low capital efficiency. Quite the opposite. The capital efficiency of Dare V2, I think, has already been higher than I think any other DApps in this sector, the derivative sector. But we realize that if we just don't do the liquidity management part of the job ourselves and leave that job to somebody who specializes on this, then the capital efficiency would be even better and more scalable. And that's the idea of Dare V3. And that somebody specialized on this turns out to be Venus, the money market protocol, or called lending protocol, which is already naturally playing the role of managing liquidity. And that is why we think almost every project needs to answer this question. So what is the core of your business? Is it from that liquidity perspective, is the core of your business using liquidity or managing liquidity for some others? So if your project, the core of your project belongs to the former, then you might want to just separate the role of managing liquidity and leave it to someone specialized on this. So this is the basic idea of Dare V3. So I think that's an essential part of the DeFi 2.0.
That's really awesome. Definitely looking forward to the launch of V3 and learning more about it. Brad, interested to hear your thoughts about it. The Zero X Alpha shared some really interesting points here. Would love to hear about how do you really think about capital efficiency from the point of a liquidity manager and as a lending protocol?
Yeah, and this V3 launch is something we're really excited about too, of course, since we're partnering with Dairy. I think this is going to be a huge model for the ecosystem and something that we're going to be replicating with a lot of other protocols because it makes a lot of sense to solve for capital inefficiency. And look, I think this is the key to a lot of growth is solving for this and getting at this at these methods for advanced liquidity, so we can do more to unlock opportunities like under collateralized financing and extend these use cases to streamline real world financing for entrepreneurs, real estate, so on. So I think there's going to be an ocean of liquidity coming in. These partnerships help to enable that. And so we'll see. I mean, what we're talking about today, it'll have its, and we'll see if it has its NFT moment in 2022 and brings in to bring in a lot more utility and use cases and excitement. So 2022 is going to be, I think, a really big year for Venus. And look, if right now you have these DeFi towns where pools of liquidity are existing separately from one another, right? And as we see, there's convergence around cross-chain collateral and liquid staking. These capabilities around stake once, use anywhere, that will just be the beginning of what people can do, and it'll have a very clean user experience so that more and more people can take advantage of this. Right? We want to push this out really to the next billion people and have it have its app store moment. So you come to the town that you choose to interact with, and all the possibilities of finance that cater to those communities, regardless of where the liquidity is going or coming from, is just very, very simple to access and giving people real world use cases around this. So I think we're putting together the building blocks to make a lot of this possible. But look, like I said, a major source of capital inefficiency in the current system is the segregation of these funds in different chains. So we really want to bring it together. Some chain, and right now, for example, the bridges attempt to overcome this issue. But I think there's a lot of work to do to decreasing the cost and time required for cross-chain liquidity to move around. And that's really going to be another big focus of DeFi 2.0 and what Venus wants to tackle in 2022. So lots of stuff to be excited about.
That's super interesting. I think that's definitely like a very new area of innovation, like this concept of composable liquidity. I've heard that Venus is also doing something similar with Qubit and other protocols that are going to be leveraging Venus liquidity in other ways. Could you tell us more about that?
Yeah, absolutely. So this is a really big part of what Venus wants to enable is having more Legos with partners like Qubit. And I'm sure if they were here, they'd want to talk to it. But Venus is a leader in the ecosystem. And so we want to have a lot of enablement from our side so that people like Qubit can come in and people like Dairy can come in, plug in, and drive that composability, which really underlies the magic of DeFi, right? That anybody can be a financial builder. Anybody can enable new capabilities. And so we want to do a lot more of what Qubit and Venus are doing. It's a win-win. And so it helps us to really solve for the capital inefficiency piece as well. So yeah, I think it's going to be great for us to replicate that one as well across the ecosystem, not just our partnership with Dairy, but with Qubit too.
Awesome. Thanks a lot, Brad. So also interested to explore some of the different models around attracting liquidity in more sustainable ways, instead of or ways that kind of address issues around providing users with liquidity mining incentives from a project's native token. At this point in DeFi, I think it's something that's it has to be done. It's expected from users. There's not a lot of alternatives around it today, but there are kind of creative solutions around how to reduce some of the limitations and issues, particularly like a high and constant selling pressure on the token and other types of issues around that. 0x Alpha, interested to hear some of your thoughts around that, and how do you guys try to approach this particular issue in terms of sustainable liquidity growth? You're on mute, 0x.
All right, sorry, sorry about that. So yeah, sustainable liquid growth. I think in the end of the day, it still comes back to the keyword capital efficiency. So so the liquidity that the liquidity providers provide the project, they provide it here for some purpose, right? So for whatever, so this is spot trading or like derivative trading, or it's a lending, or like leverage yielding, whatever, for some purpose. So you have to. So in the end of the day, is what your product delivers to the liquidity providers. So that is I think in long run, that is the only thing that matters to the liquidity growth, because that's the only thing that can attract your liquidity providers to be here for the long time. I mean, in short term, you can like maybe like provide like a very high APY, like with your own project tokens or something like that. But that obviously that's not a sustainable way. So the ideal model is kind of like right now so the ideal model is kind of like so right now I think for example Uniswap is one of the few projects that when they're not providing any token project tokens as the incentive, but still they're both the trading volumes and their TVL are growing. So I think that's the role model that every project that needs to learn from. And so and the reason of that is I think one big upgrade from like Uniswap V2 to V3 is about capital efficiency, right? So in the end of the day, it's still like how with every single cent of the liquidity that your liquidity providers send to your project, what you deliver for him or her. So that's the one thing that matters in the end of the day. So again, just brings us back to the topic capital efficiency.
Yeah, definitely. Thanks a lot for that. So I thought we could switch gears a little bit and talk a little bit about some of the trends happening in the stablecoin space. James mentioned a little bit about AUSD. We'd love to hear more about that as well. But we're also seeing, as part of these kind of DeFi 2.0 trends, very significant growth in non-fiat peg stablecoins. It's kind of a very new concept. So, like, we've had algorithmic stablecoins for a while now. Today, the growth of Frax and other projects also show very significant growing demand in the market. So maybe we could start with you, James. Like, I would love to hear your thoughts on how you see that space evolving, especially the growing demand around non-fiat peg stablecoins, and the role that AUSD, the problem space that AUSD is try to play in.
Yeah, sure. So I think there's several reasons why there's sort of heightened interest in non-peg stablecoins, particularly right now. So I think first of all, for many protocols, it can be challenging to maintain the exact peg, right? Like that is one of the main reasons why people are looking outside of that, especially in phases of sort of lower demand. At AUSD, we have certain methodologies I can go into a bit later as to how we do that. But I think secondly, I think, Tether and USDC are great, but if you build crypto apps on top of assets that can be regulated, then they will also be regulated in the end, and this inevitably ends up holding DeFi hostage to some extent, right? So I think the only way that you can kind of solve this is if you come up with a truly decentralized and unbiased form of money. And so hence the sort of interest there. I think thirdly, also, like in times of expansionary monetary policy, such as now, people's purchasing power is constantly being eroded. which is kind of like, I think this point speaks more to where I'd like to see stablecoins go eventually, which is whereby they effectively oracleize sort of real product prices in the world, sort of finding the right basket that consistently represents real value relative to most people's lives. And that's where I think the decisive stablecoin will end up pegging its price to, right? Not some fiat currency that could go haywire with one sort of dodgy administration. I think one of the projects, as you mentioned, looking at versions of that right now, and I think you're doing a great job, is Frax. I think that they're looking at that kind of like that basket of goods kind of context to drive things forwards. I think you also mentioned Olympus earlier. I think that, like, although demonstrating some pretty cool concepts such as protocol and liquidity and stuff, I'm yet to be convinced that their model of like this freely floating algo stablecoin is sustainable long term. I think that it still relies very heavily on large staking returns and sort of early adopter discounts to generate hype. That's kind of like a wait and see, in my opinion. But yeah, I mean, I don't want to go too much into, like, the AUSD is slightly separate to all this. That was more sort of functioning towards sort of increasing capital efficiency for our own protocol, as opposed to sort of, I don't want to go off topic, but I know that you guys were sort of more interested in the non-fiat peg stablecoin stuff, so I'll let somebody else have it. There you go.
Yeah, the very interesting insights even on that one, James. Definitely, I think a lot of valid points. I think also definitely the new token models introduced by projects like Olympus DAO are still at fairly early stage. User growth alone doesn't kind of demonstrate much on the risk side, especially in the current market environments. I think we still have still yet to be battle tested further to see how sustainable those kind of models are going to go long term, for sure. So I think there is definitely considerable risk in any type of new models that are, and with those risks still apply, as they've not been fully tested yet through all types of market conditions, for sure.
Yeah, and I think that I that's not to, like, I'm not putting them down or anything. Like, there have to be a lot of experiments to kind of see what will be the model that ends up succeeding the most. And DeFi 1.0 had huge advantages to it, and we found out that certain things didn't function as well, and that's going to be the case for DeFi 2.0, 3.0, 4.0, 5.0. That's the beauty of what we do, right?
Yeah, thanks a lot, James. Brad, would love to hear your thoughts on that. I know you spend a lot of time thinking about this topic and stablecoins in general. Would love to hear more about how you see that market evolving, as well as any kind of trends you're seeing in the demand side. Particularly interested to see not only about non-fiat pegged stablecoin, but non-USD pegged other currencies, fiat currencies, whether it's euro or other. Like, do you see demand for that? Do you think that that's going to emerge anytime soon, or is it largely going to remain on the fiat side pegged to USD?
I think there's going to be a huge demand here. I mean, if we just look at the demand rates now for stables, I think this is just the edge of it that we're seeing, and it's going to open up a lot. And just on the Olympus DAO sentiment in the room, I think I echo that. That model of having protocol-owned liquidity, it can create some efficiency advantages, right, for protocols, but those efficiencies break down if all protocols try to replicate the same model. So instead, I think what's another interesting model is the liquidity as a service innovation, like Tokamak, where liquidity can be efficiently pooled and redirected when needed. I think you'll see a lot of this being utilized in the future of DeFi. And I'm sure we'll see even more liquidity as a service innovations created 2022 and beyond. But back on the topic of non-fiat pegged stables, I mean, this is definitely an important part of the future of money. Ohm on the Olympus DAO side, they claim to create an alternative currency by backing themselves with this basket of assets. But the basket is just a combination of stables and other digital assets. And we are, as human beings, we really are used to transacting in the physical world and needing physical things, right? So, well, at least for the moment, probably Elon Musk is working on uploading us to the metaverse with Neuralink. But in the meantime, economics at its core is really about the transfer of physical assets. So any transaction focused human currency that will be accepted as a stable requires a basket of assets that live in the physical world. And I think this is why real world assets, bringing that into the fold, is so important. Digital assets in their current form don't represent the physical world that we rely on. So the future of money is crypto, but only when we extend those capabilities out, bring the capital efficiency and leverage to the real world. So we're seeing a lot of these 0 to 1s in that space, and we're going to be seeing a lot more scaling and adoption in this area in 2022 is my prediction. We're just at the beginning, right? So I'm really excited about that area in general.
Awesome. Thanks a lot, Brad. Also wanted to touch on a little bit further more on the topic which you mentioned. Definitely, we've seen very significant growth with these type of liquidity as a service models like Tokimac. I think others projects as well playing a similar area, projects like Convex and others that are kind of improving, making very significant improvements in the area around capital efficiency for DeFi protocols. I think another area that we're also seeing very significant growth and probably expect to see continued growth is in the area of cross-chain, multi-chain DeFi. So I think there we do see a lot of projects increasingly multi-chain, like a lot of developments on the technology side around bridges as well. Interested to talk a little bit more about that and how you see that evolving. How are DeFi protocols really thinking about liquidity across chains? Um, um, from a user experience perspective, also interested to hear from a demand perspective. How do you what is the kind of demand you're seeing in your respective communities? Maybe we can start with you, James.
Yeah, I mean, it's something that we're always looking at. I mean, we're only on BSC for the moment, but I mean, I think that the future is cross-chain, it is multi-chain. We want to be able to have the largest amount of liquidity possible and serve the most amount of people possible, right? So it's one of these questions that we have been discussing for like ever since we came into the market, right? It's not as easy as most people think it is. It's not just a case of like just plugging in and going. It's you have to. I mean, I'm not a product guy, but I'm the one leading these conversations with a lot of the other chains and other protocols and stuff. And I think you have to kind of. The protocols that have gone cross-chain haven't had necessarily the success that most people would have thought up to now, and it's because there are these kind of like these technical difficulties that get in the way, right? So you see some of the big sort of DeFi 1.0 lending protocols, whether it be Aave or these guys, and you suddenly see kind of the APYs and the liquidity that they're getting cross-chain, and it wasn't necessarily as much as we thought it would be. So I think it's it's an evolving process. I think that what Brad was saying earlier about sort of composability with other protocols is probably like the first step, right? And so it's just getting other protocols within BSC to kind of to work in sort of partnership, and then little by little we can start looking at sort of cross-chain stuff. But it's something that will inevitably happen. It is difficult. It's really tough to achieve. So yeah, but we've always got our eyes open and we are looking for this stuff. So
Yeah, so like some really interesting points there. So for sure, I think it's been quite varied, the level of success of a lot of DeFi protocols going multi-chain. And I think the end result is also not known yet, because today for a lot of those protocols, the yield sourcing or where that yield comes from and how the APY composition today looks like will change, because today a large portion of that comes from liquidity incentive programs from the protocol foundations and others. So obviously that won't happen forever. So when I think that could be another area around where we do see more innovation happening. I think there's going to be also driven a lot by what uh, all of you guys have been talking about really is the yield sourcing. So that's like the true driver of sustainable liquidity growth, is providing like use for a high and continued innovation and use for your communities and user base, and having that innovation in the yield sourcing. Um, Interested to hear your thoughts about that, Derry, about sorry, 0x Alpha, around how do you guys think about going multi-chain, and how do some of these issues around capital efficiency affect those decision processes?
Yeah, actually, multi-chain is one thing we are currently exploring too. Actually, you probably know that Dare Protocol actually started as a multiple chain project. It's just within our growth, and just gradually we become a Binance Smart Chain centered. Our community become Binance Smart Chain centered. But when we started, when we talk about multiple chain, we really means we deployed the apps on different chains, right? So this is like right now it's like a very popular practice for example, there's even project, I think they adopt not just multiple chain, but like it's like every chain policy, like SushiSwap. They pretty much deploys on every EVM compatible chain, right? But that's a different thing from what the multiple chain thing we're talking about here, because obviously the different the smart contracts of the SushiSwap on different chains, they don't communicate with each other. They're separate. But right now, the multiple chain we're talking about, and also we're exploring here, is that we try to unify things that are taking place on different blockchain networks. We are actually planning to add cross-chain features in the next version of Dare Protocol, the Dare V4. We're already in talks with cross-chain infrastructure projects like AnySwap and also a Seller network. So they are right now building the infrastructure for the apps to call functions across networks. For example, you can call a function within a smart contracts on Ethereum from a smart contract on Binance Smart Chain. So imagine if that channel has been built, one thing we can do is here, you can actually leverage the right now all the huge TVLs on Ethereum, but you can, but in the same time, you leverage the low gas cost on Binance Smart Chain, right? So, so what if you want to, okay, say you can put some of those complicated or advanced functionalities, which are usually gas consuming. For example, derivative trading is one good example. A good example for that. For the everlasting options trading on their protocol, they are pretty gas consuming. So so that actually from the function running perspective is proper on Binance Smart Chain. But if this cross-chain communication channel has been well built, then we can imagine we can build something. The liquidity pool is across two chains, so that all the trading happens on Binance Smart Chain, but in the same time we can leverage the liquidity on Ethereum. So that's one possibility, and that's also something we are imagining on Dare V4. And we are already discussing with AnySwap and the Standard Network for that kind of possibilities.
That's super cool. So does that mean we can expect in V4 to see external custody partners that are on other chains, right?
Yes, that exactly. You got it. That's the point.
Awesome. Um, Brad, would love to hear from you on this topic as well. Like Venus obviously is native on BSC today. Interested to hear about how do you see that kind of multi-chain DeFi thesis playing out, especially with so many challenges around that. Like there is, I think, a lot of different ways to think about multi-chain. There's the sushi swap model where you have just kind of ring fence deployments across different chains where you don't really have really cross chain natively cross chain kind of things happening there, you know, with like assets being collateralized on one chain and loans being issued on another chain. So obviously these kind of things are coming. They are coming soon, like with technologies like Seller C Bridge and Layer Zero that allow for these type of efficient cross-chain message passing. I think it's still quite early there, but that's definitely one of the super exciting areas to look forward to in the coming weeks and months for sure. Interested to hear about how you guys are thinking about that.
Yeah, the deploying instances of your protocol on different chains, it seems like a quick fix. I don't know if it's really where ultimately the puck is going and how we're going to realize this future with cross-chain liquidity, cross-chain collateral. But look, it boils down to decreasing the cost, decreasing the time to move this liquidity, right, and to move it around. I think that's why we're all on BSC, is that it's low cost, it's fast, and so now we want to make this possible with doing it anywhere. I'm excited about the promises that some new developers bring around things like Layer Zero. And I think their language is right. I mean, they talk about it as an omni-channel interoperability protocol. So I think the paradigm is going to go from cross-chain and multi-chain to omni-chain, right? And think about unifying things, unifying capabilities so that you can plug in anything. I think this will be key. But let the market compete for a user's attention, demand, liquidity, anywhere from wherever he is, so that we don't have to plug it into individual chains. Inevitably, there's going to be more chains popping up. It's not sustainable and scalable to launch your protocol every time there's a hot new chain coming around, right? We have to think about it differently. So decreasing the cost and the time, thinking differently about how we're architecting the solutions, and getting the user experience right. And I think that's connected to getting the cost and time down, right? So BSC has an amazing user experience. That's going to be the key to unlocking the real power of cross-chain offerings when it comes to lending. And so not just on the cost and the time, but creating a passport for people so that they can access any of the services that are available out there, regardless of the chain. So I think we'll see a lot of this in 2022 for sure. I think we had some 0 to 1s. People are doing the experiments around this, but I think we're really going to open up the innovation in this area this year.
I think even here some super interesting points that you brought up. So I think in some domains, like obviously we're increasingly in a multi-chain world today, and in some domains like in the gaming and NFTs, for example, I think there the users care less about which chains they're on. Sometimes they don't care at all. But for I think DeFi users, they do care more. And I think of it more like how do people choose about living in the country that they choose to live in? You know, it's about lifestyle, it's about access points, it's about a number of different features or weather and stuff like that. From a chain perspective, it's depends on things that matters more for users. For some, it's maximally decentralized network architectures. For others, it's scalability and transaction fees, access points to their favorite centralized exchanges, for example. So it's a number of different things, but from DeFi protocols perspective, of course, they want to be able to capture more total addressable market, and that in the initial stages means being in chains where there's a large number of users, but eventually when really multi-chain applications start developing, I think a lot of that's going to be driven by user preferences around the chains that users want to be on and do their activities on. It was a super interesting discussion here. To close things out, I think we can just have a quick run through. Would love to hear about any of the key updates you'd like to share with the listeners, as well as where the audience can go to catch up on the latest news about developments in the project. Maybe we'll go in the reverse order this time, starting with you, Brad. Okay, Brad, I think you have some connection issues, Brad. Let's come back to you in a sec. We'll go to James.
Yeah, so at Alpaca, obviously, we've been pretty hard at work on the product side. We obviously introduced AUSD, which I went through a little bit earlier. We also have our governance staking vault, which came to market about 1 or 2 weeks ago. So yeah, I mean, we've been really hard at work on the product side. We're also trying to, as I said, have these conversations around cross-chain. But yeah, for people who wanna know more, we have like an incredible docs section of our website. We have the Alpaca Academy for people that want to really go into detail about the best way to use our products, because sometimes leverage yield farming can be a little bit tricky for people to understand, and so we try to make it as clear and transparent as possible. But yeah, I mean, we're hard at work. We're looking at the institutional side at the moment. We're looking at producing an institutional product this year. We're currently working on that right now. We don't know the best way of going about it, but we have sort of 3 or 4 ideas that we're playing with, and we're working pretty hard at that. So yeah, just keep your eyes peeled. We'll be, you can find us on Telegram, on Discord, everywhere. And feel free to ask me any questions in the Telegram chats and the Discord chats, or on Twitter. Like I'm always there to answer any questions that people may have.
Awesome. Thanks a lot, James. 0x Alpha.
Okay. So 2022 is going to be a super exciting year for Dare Protocol. There will be a number of major milestones for us. Next week, we're going to roll out There Will Be 3, which I discussed just now. This is be with a partnership with the Venus Protocol too, and I think the partnership is going to be a defining partnership for the so-called DeFi 2.0, and it will bring the capital efficiency of derivative trading to a new level. What's also important in the There Will Be 3 is that we have a brand new DPMM. Our new AMM model, which actually universally supports all of the so-called funding fee-based perpetual derivatives, including the two that we currently support, the perpetual futures and the everlasting options, but will very soon support the power perps, and many more funding fee-based perpetual derivatives will be supported next. And as I pointed out, the new DPMM will support these derivatives, all of these derivatives universally, meaning one pool can support even multiple different kinds of derivatives. So we're going to organize the liquidity for derivative trading in a very new way. So that's all of the amazing things that will come with There Will Be 3. And also just now, I just realized I accidentally leaked what's going on with There Will secretly, the There Will Be 4. The thing, actually, that's something we've never talked about before, but just now Sammy mentioned this cross-chain topic, and I accidentally leaked that secret, which is fine. So that's going to be another major milestone in this year, 2022. So everybody, please stay tuned for what will happen with their protocol. Thank you, Sammy.
Awesome. We got a lot of Dairy fans, a lot of 0x Alpha fans here as well. I'm also a really big one, so thanks a lot for joining us on this one. Brad, over to you.
Thanks. Yeah, Venus has made a lot of progress on its journey with a community of tens of thousands in countless countries around the globe. But there's still a great deal of work to do, as the community has been signaling, to get to that level of innovation that Venus should be reaching with a DAO of its scale. Um, Venus is now entering a phase of expanding use cases that the community is demanding. So 2022 is going to be that year for Venus that I think it really hits its stride, because a new team has been installed, and the mandate is to realize all the community's asks, getting Venus out there as a trusted and robust DAO for universal money markets, and seizing this kind of continuous watershed moment that crypto is having. More and more people are being pushed into Web3 because of super high inflation, unacceptable performance by banks, corruption of Web2 platforms, and what the Masari report calls a collapse of institutional trust, right? So I think another billion people are soon going to take the red pill, fall down the rabbit hole, and Venus wants to be there to capture them. So we need to solve for things that we've been talking about on this call, like liquidity as we scale, because we've barely just begun. One of the things that we've done as a new team, we recently did a community survey, and now a proposal is being built to address all that feedback, and it will constitute the next major release of Venus, which will be the biggest release, I think, of the protocol's history. So that's what the community should look out for. I think it'll send a big signal to the market about the new management team, the new change in direction, and I'm really excited to get everyone's feedback.
That's really awesome. Thanks a lot, Brad. Uh, this was a really great conversation. Want to thank you guys for taking time off on your weekends to come and join your communities and the BSC communities, discussing this topic around advanced and new liquidity models, and in the new era of DeFi. We've got a lot of exciting things coming in Dairy, Alpaca Finance, and Venus Protocol as well to look forward to. Thank you guys a lot for joining us. Have a great weekend, everyone.
Thanks, guys.
Thanks, Sammy.
Everyone.
Bye, everybody.
Bye.